Something unusual is quietly building in the Ripple ecosystem right now. And if you are only watching XRP price charts without looking at what is happening behind the scenes in the United States, then you are missing the real game that smart money is already positioning for. Because when liquidity starts shifting, when institutional wallets start adjusting exposure, and when regulatory signals begin to soften or tighten in unexpected ways, the market does not move randomly. It moves in a direction that most retail traders only understand after the move has already happened. And today we are breaking down exactly what is forming underneath the surface that could potentially reshape XRP's short term and mid-term market structure in ways many are not prepared for. When we talk about Ripple XRP and its current position in the US financial environment, the first thing that must be understood is that XRP is no longer just a retail driven speculative asset sitting on exchanges waiting for hype cycles. It is increasingly being positioned within a broader institutional narrative where cross border settlement efficiency, liquidity provisioning, and blockchain based financial messaging systems are becoming central discussion points among banks, fintech institutions, and regulatory observers, especially in the United States, where compliance frameworks are tightening around digital assets. And this is exactly where the behind the scenes activity becomes extremely important to analyze. Right now, one of the most significant underlying factors is the evolving liquidity dynamics across crypto exchanges and OTC desks, where XRP is often used as a bridge asset for settlement flows, meaning that large volume transfers do not always reflect directly in spot price movements immediately, but instead create delayed pressure that eventually impacts volatility when liquidity imbalances reach a threshold. And this is something that retail traders rarely monitor because it does not show up clearly on basic exchange charts. Yet it plays a critical role in how price action develops during accumulation and distribution phases. At the same time, US based regulatory sentiment continues to act as a silent catalyst in the background because every update related to Ripple's legal positioning, compliance clarifications, or institutional adoption signals influences how market makers hedge their exposure to XRP across derivatives markets. And this hedging activity often creates artificial stability or suppression in price movement before larger directional shifts occur, which means what you see on the surface is often not the real reflection of underlying positioning, especially when options markets and futures open interest start expanding without proportional spot volume confirmation. Another key factor that must not be ignored is the growing participation of institutional grade liquidity providers who are increasingly interested in assets like XRP due to their settlement speed and cost efficiency compared to traditional Swift based systems. And even though public announcements are limited, on chain analytics and wallet activity patterns suggest that accumulation behavior tends to occur in controlled phases, where price is deliberately kept within certain ranges to allow strategic entry, which again reinforces the idea that the market is currently in a structured positioning phase rather than a purely organic retail driven rally or decline. What makes this situation even more interesting is the behavioral pattern of XRP during low volatility periods, where extended consolidation often precedes sharp expansion moves. And historically, these compression phases are associated with liquidity buildup rather than market inactivity, meaning that what looks like stagnation is actually a preparation stage for potential volatility expansion, especially when combined with macroeconomic triggers such as interest rate expectations, USD liquidity cycles, and crypto risk sentiment shifts across global markets. So, when we connect all these elements together, regulatory influence in the USA, institutional liquidity positioning, derivatives market behavior, and on chain accumulation signals, it becomes clear that Ripple XRP is currently sitting in a structurally sensitive zone where external catalysts could quickly translate hidden pressure into visible price movement. And the real challenge for traders is not identifying whether something is happening, but understanding what phase of the cycle the market is currently in before that information becomes obvious in hindsight. We will break down how US market sentiment and Ripple related developments are directly influencing short term XRP price behavior and why certain price levels are becoming critical decision zones for both institutional and retail participants. If you look at XRP's recent behavior purely from a retail trading perspective, it might feel like the market is slow, indecisive, or even manipulated within tight ranges. But that interpretation is missing the deeper reality of how US market sentiment is currently shaping liquidity flows across the entire crypto sector because XRP is not moving in isolation anymore. It is increasingly reacting to macro positioning, derivatives exposure, and institutional hedging behavior that originates from US based trading activity. And this is exactly why price movement feels inconsistent compared to earlier cycles where retail volume had more direct influence. The most important factor driving this environment is the shift in risk appetite across US financial markets, where expectations around interest rates, inflation stability, and liquidity tightening or easing directly impact how capital rotates between high risk assets like cryptocurrencies and lower risk traditional instruments. And XRP, being one of the most established altcoins with institutional narrative potential, tends to react more sharply when liquidity conditions shift even slightly, because it sits in a category where it is neither purely speculative nor fully adopted as a mainstream settlement layer, creating a hybrid sensitivity to both retail sentiment and institutional positioning. At the same time, XRP's price structure is heavily influenced by derivatives markets in the US, especially perpetual futures and options contracts, where open interest data often reveals more about market positioning than spot trading volumes. And what we are currently observing in many cases is that funding rates and leverage ratios fluctuate in a way that suggests large participants are actively managing exposure rather than committing to directional conviction, which creates a controlled volatility environment where price movements are intentionally compressed to absorb liquidity without triggering aggressive liquidations on either side. This is where retail traders often misinterpret the situation because when volatility decreases, it is commonly assumed that nothing is happening. But in reality, low volatility phases are often where the most significant accumulation or distribution takes place, especially when market makers are balancing long and short exposure in preparation for a potential catalyst. And in XRP's case, this becomes even more relevant because historical cycles show that extended consolidation often precedes rapid expansion moves that are triggered by external news flow or sudden shifts in sentiment across the US regulatory or macroeconomic landscape. Another critical element currently influencing XRP behavior is the psychological impact of ongoing ripple related narratives within the US financial ecosystem, where every small update related to partnerships, banking integrations, or legal positioning has a disproportionate effect on trader expectations. And this creates a sentiment driven volatility layer where price reacts not only to actual developments, but also to perceived implications of those developments, which means even neutral news can sometimes produce exaggerated short term price reactions depending on how market participants interpret its long term significance. In addition to that, liquidity distribution across exchanges has also become more fragmented, meaning that XRP price discovery is no longer driven by a single dominant venue, but rather a combination of centralized exchanges, OTC desks, and cross border liquidity channels. And this fragmentation allows large players to execute positions more discreetly, which reduces transparency in short term price action and increases the likelihood of sudden directional moves when aggregated liquidity thresholds are reached. What this ultimately tells us is that XRP is currently in a phase where US market sentiment is acting like a pressure regulator rather than a direct catalyst, keeping price movement contained while underlying positioning continues to evolve. And this is exactly the kind of environment where strong moves often build silently before becoming visible to the broader market. We will go deeper into institutional behavior patterns, on chain signals, and how smart money positioning is quietly shaping XRP's next potential breakout or breakdown zone without most retail traders realizing it is already in motion. When you start analyzing Ripple XRP from an institutional lens rather than a retail trading mindset, the entire structure of what is happening behind the scenes becomes far more complex and far more intentional because large financial players do not enter or exit positions in a visible or emotional way like retail traders do. Instead, they operate through structured accumulation phases, liquidity hunting strategies, and derivatives based hedging models that are designed to minimize market impact while maximizing entry efficiency. And this is exactly why XRP often appears stuck before major movements, even though beneath the surface, a significant amount of positioning is already taking place. One of the clearest indicators of institutional involvement is the behavior of liquidity during low volatility consolidation phases, where price remains confined within a tight range while volume distribution subtly shifts across exchanges and OTC channels. And this type of structure is typically not accidental, but rather a reflection of controlled accumulation or distribution, depending on broader macro conditions. And in XRP's current environment, the pattern aligns more closely with accumulation behavior rather than exit driven distribution, especially when combined with long term on chain wallet activity that shows gradual increases in holdings among larger address clusters rather than sudden spikes that would indicate speculative inflows. Another critical aspect is how smart money uses derivatives markets to mask directional intent. Because in modern crypto markets, the spot price alone does not reveal true positioning. Instead, funding rates, open interest expansion, and liquidation heat maps provide a much clearer picture of where leverage pressure is being built. And in XRP's case, there are periods where open interest increases while spot volatility remains muted, which usually indicates that positions are being built in a neutral or slightly biased direction without triggering immediate price movement, essentially creating a compressed energy structure within the market that can later expand rapidly when liquidity conditions shift. At the same time, institutional participation in XRP is often tied to broader narratives around cross border settlement efficiency and blockchain based liquidity transfer systems. And while public disclosures remain limited, the underlying infrastructure discussions within US financial institutions suggest that assets like XRP are increasingly viewed not as speculative instruments, but as functional liquidity tools that can be integrated into faster settlement frameworks. And this shift in perception is extremely important because it changes how capital is allocated over time, moving from short term trading cycles toward longer term strategic positioning. On chain analysis further strengthens this view because wallet behavior patterns often show accumulation clusters where XRP is transferred into fewer, larger wallets over time, reducing exchange supply without creating immediate price spikes. And this type of movement typically indicates preparation rather than liquidation, especially when exchange reserves gradually decline while price remains stable, suggesting that supply is being absorbed quietly rather than being actively sold into the market, which is a strong signal of underlying demand building beneath surface level price action. What makes this phase particularly interesting is that it often precedes high volatility expansion events because once liquidity on the sell side becomes thin enough and leverage positioning reaches a critical imbalance, even a relatively small catalyst, whether macroeconomic, regulatory, or sentiment driven, can trigger a disproportionate price reaction, and XRP has historically demonstrated this type of behavior during previous cycles where long periods of compression were followed by sharp directional moves that caught a large portion of the retail market off guard. So, when you combine institutional accumulation patterns, derivatives positioning, liquidity compression, and on chain supply dynamics, what emerges is not a random market structure, but a deliberately balanced environment where smart money is preparing for a potential revaluation phase, while retail participants often remain focused on short term price noise without recognizing the underlying structural buildup. We will focus on key technical levels, liquidity zones, and critical price thresholds that are currently acting as decision points for XRP, and how these levels could determine whether the next major move is a breakout continuation or a deeper liquidity sweep before reversal. At this stage, XRP's price structure is no longer just about random intraday movement or simple support and resistance lines drawn on a chart. It is increasingly about liquidity zones where large clusters of buy and sell orders are stacked, and these zones act as decision points for market makers and institutional participants who are actively managing risk exposure while waiting for optimal conditions to expand price in a controlled direction. And this is why the current XRP range should not be viewed as inactive, but instead as a highly strategic compression phase where every level matters more than it appears on the surface. From a technical structure perspective, XRP is currently sitting inside a multi layer consolidation zone where repeated rejections and rebounds are forming a liquidity corridor, meaning that price is being absorbed between upper supply resistance and lower demand support. And within this corridor, liquidity is constantly being tested to identify weak hands on both sides. And this process is essential before any major breakout or breakdown because it allows large players to build or offload positions without creating immediate destabilization in the market. One of the most important aspects of this structure is the concept of liquidity sweeps, where price temporarily moves beyond key support or resistance levels, not to establish a new trend immediately, but to trigger stop loss orders and absorb liquidity from retail traders who are positioned too tightly. And in XRP's current behavior, these sweep zones are becoming increasingly visible around psychologically significant price areas where traders tend to cluster their risk. And this creates predictable pockets of liquidity that can be targeted before any sustained directional move begins. At the same time, volume profile analysis shows that a significant portion of trading activity is concentrated within a mid range zone rather than at breakout extremes, which suggests that market participants are still in a state of equilibrium where neither buyers nor sellers have full control. And this equilibrium phase is often the final stage before volatility expansion, because once imbalance develops in either direction, the market tends to move quickly to reprice inefficiencies and capture remaining liquidity pockets. Another critical factor is the behavior of XRP around long term moving averages, which are currently acting as dynamic equilibrium levels rather than strict support or resistance barriers. And when price repeatedly interacts with these averages without strong rejection or acceleration, it indicates that the market is coiling energy rather than establishing a clear trend. And this coiling effect is often amplified when combined with declining volatility and tightening price ranges, which is exactly the type of environment that precedes strong breakout events in both directions. What makes this phase particularly important is that many retail traders misinterpret it as lack of momentum, but in reality, this is where positioning becomes the most important factor, because smart money does not need price to move aggressively while building exposure. Instead, it benefits from stability, predictable ranges, and controlled volatility conditions where accumulation or distribution can occur without attracting excessive market attention. And XRP currently fits this profile more closely than a trending market phase. Additionally, psychological price levels play a major role in shaping short term behavior because round numbers and previously established highs or lows tend to act as emotional decision points for traders, creating clusters of stop orders and limit orders that form natural liquidity pools. And XRP is currently interacting with several of these zones, which increases the probability of sharp reactions once those levels are tested again with sufficient volume pressure. So when we combine liquidity sweeps, volume concentration, moving average compression, and psychological price clustering, what we are seeing is a highly structured environment where XRP is essentially being prepared for a larger directional move. And the only uncertainty is not whether a move will happen, but rather which side of the liquidity imbalance will break first and trigger the next expansion phase. We will connect all these elements together with macro catalysts, regulatory influence, and potential triggers from the US financial environment that could act as the final push for XRP's next major move, along with a clear closing perspective on what market participants should realistically expect next. When you step back and connect all the moving parts around Ripple XRP, what becomes clear is that the market is not operating in isolation anymore. It is deeply tied to macroeconomic liquidity conditions, US regulatory sentiment, and broader risk appetite across global financial systems. And this combination is exactly what makes the current phase so important because XRP is sitting in a structurally sensitive position where even a single external catalyst can shift the entire market direction rapidly once internal liquidity conditions are aligned. One of the biggest macro drivers right now is US monetary policy expectations because interest rate direction and liquidity availability directly influence how capital flows into risk assets like cryptocurrencies. And when markets anticipate easing conditions or improved liquidity supply, capital tends to rotate into higher beta assets, and XRP, due to its established market presence and institutional narrative, often becomes part of that rotation cycle, especially when investors begin looking for assets that have both utility narratives and speculative upside potential. At the same time, regulatory clarity in the United States remains one of the most influential background factors for XRP's long term positioning, because any shift in legal interpretation, enforcement tone, or institutional acceptance of Ripple related infrastructure can immediately change how market participants price future risk. And even without direct announcements, sentiment around regulatory progress often acts as a forward looking pricing mechanism where traders adjust exposure based on expected outcomes rather than confirmed events, which creates preemptive market reactions before actual news is fully confirmed. Another major trigger comes from liquidity expansion or contraction cycles within crypto markets, because when liquidity increases, volatility tends to expand across altcoins as capital flows more freely between assets. And when liquidity tightens, markets compress and prepare for future expansion phases. And XRP is currently showing characteristics of a compression phase where volatility is reduced, but underlying positioning suggests that exposure is being structured rather than reduced, which is often a precursor to directional expansion once liquidity conditions shift again. Institutional adoption narratives also continue to play a silent but powerful role because XRP is frequently discussed in the context of cross border settlement efficiency and real time liquidity transfer systems. And while public announcements may be limited, the gradual integration of blockchain based financial messaging and settlement solutions across fintech infrastructure in the US creates long-term demand expectations that influence how large participants allocate capital over extended time horizons. And this type of positioning does not show immediate price spikes, but instead builds pressure over time. What is most important to understand in this phase is that XRP is not waiting for a single event. It is waiting for a convergence of conditions where macro liquidity, regulatory sentiment, derivatives positioning, and spot accumulation align in a way that removes resistance barriers and allows directional movement to unfold with momentum rather than hesitation. And when these conditions align, the move is often fast enough that retail participants who are not positioned early tend to react after the majority of the move has already occurred. So, the real takeaway from this entire structure is not that XRP is about to explode or about to crash, but rather that it is currently in a high sensitivity zone where probability of expansion is increasing, and the direction of that expansion will depend on which liquidity side gets absorbed first once a catalyst interacts with the current compressed structure. From a practical perspective, this means traders should be less focused on short term noise and more focused on structural confirmation, liquidity zones, and macro alignment, because those are the factors that will determine whether XRP transitions into a breakout continuation phase or a deeper liquidity reset before establishing a new directional trend. This video is strictly for educational and informational purposes only and should not be considered financial advice, investment guidance, or a recommendation to buy or sell any cryptocurrency or financial asset, because the crypto market is highly volatile and involves significant risk, and every trading or investment decision should be made based on your own independent research, risk tolerance, and financial situation. Like this video and subscribe for more professional daily XRP market updates, structured analysis, and future insights into Ripple and broader crypto market movements.